Good morning. Welcome to Stock Market Today and happy Friday. It's October 9th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Get a lot of the great content for this show. Also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities closed higher Thursday, adding to Wednesday's gain and closing at their best levels of the day. All sectors were positive, with energy the leader. Financials, materials, comm services also outperformed. Discretionary and tech trailed the broader tape. Treasuries were mostly stronger. The dollar did not do much on the yen or euro crosses. Gold finished up 20 basis points. WTI crude settled up 3.1% and is up about 11% on the week. As we enter the final day of trading for this week, S&P futures are up 40 basis points. S&P 500 is on track for its best week since August. European equity markets are mostly firmer, following mostly bullish trade in Asia overnight. Mainland China outperforms after resuming trade following the Golden Week holiday. Treasuries are unchanged to a bit weaker at the front end. You don't hear that often. And the dollar is down on the major crosses. Gold is up 1.4%. WTI crude is down about 1% to kick us off on a Friday morning. That starts off with major markets coming up and out of these near-term consolidations. SPY breaks near-term resistance. August highs are in play. I think as long as we're above 343, then we have to be thinking about the August highs in play for the S&P 500. It's amazing that we're thinking about it. See how quickly everybody got all bared up as we started to pull back. 10% correction, everybody freaked out. But if you knew your levels, you didn't get freaked out. If you were following along with our roadmap, you didn't get scared there. You actually started to redeploy capital 2.5 weeks ago, like exactly when we started talking about it. Same goes for the Qs, up and out. We're through that key 280 level. We'll continue to watch it. But as long as we are above 280, you have to be thinking about the highs. And the big story this week is small caps. I mean, there's not anybody who's not talking about them. We've been writing about them all week. We've been kind of talking about them within the scope of, we just want to see them come to the party, right? It's a breath confirmation. The fact that they're outperforming, that's an interesting upside kicker that we have to start paying attention to. Now, in our notes and on this show this week, we've highlighted value and growth within the small cap landscape. And in that landscape, growth looks better. But bigger picture, growth over value, potentially a dent in the armor. We're going to talk about that a little bit later on, because if that were to change, that would obviously be a huge change for me, because we've been bullish growth over value and right for a long time. And if that's changing, I want to let you know about it. I want you to know that it's being closely watched at this point. You'll see why a little bit later on in the show. Now, market in a minute. What are we writing about in the note today? We touched on the fact that SPY closed over 343 as that push higher continued. And themes actually are pointing to increased risk appetite in the market. We'll take a look at a few of those later on. As I said, there is a dent in the growth over value armor, and we'll touch on it when we get to the chart part of the show. And a lot of that has to do with FANMAG stalling, I think, on an absolute and relative basis. Not going to hit that here. It's in my note. Take the 14-day trial, get my note, and you'll see it every Friday. And as I said, futures point to a higher open here today. Now, our market in a minute. Also, we touch on major indices from a power bar perspective. Dow flips bullish, 4-3 bulls to bears after adding 50 basis points yesterday. S&P 500 up 85 bips, 128-61 bulls to bears there. NASDAQ underperforms again. And I think what we're seeing is these big mega cap FANMAGs are being used as a source of funds to square up positions in front of the election. Market's starting to price in a Biden victory, I think, and who that benefits. And you're starting to see it play out here. And I think one of the groups that it benefits is small caps, domestically focused. If we increase our spending here at home, infrastructure projects, et cetera, could help the small caps here, up 1.1%, 752 to 234 bulls to bears there. Bonds uptick, yields lower. Energy, your outperformer. A lot of talk on the energy space. I am paying attention to the fact that a lot of smart people are trying to call a bottom. I don't call bottoms. I wait for the trend. to change and give me evidence that it's changing. And I'm fine with that. I'm not going to change my process, but there are a lot of smart people whose work I respect, talking about a potential bottom in energy. So when I hear that, when it comes from smart people, I start to sit up and take notice. I'm spending a lot of time reading about what's going on. I'm spending a lot of time now looking at individual energy stock charts. But I'm not going to change my view till the trend changes. That's my discipline. So, but obviously I want to be paying attention, right? Because when the trend does change, I'm going to want to know and have conviction that there's something behind it. And that's where reading up and actually understanding the stories starts to come into play. The stories give you the conviction. Let's take a look at our stock of the day now. Speaking of small caps, selectively starting to look at them. You have to. Herman Miller, MLHR, very bullish stock, strong trend, strong industry group. What I'm interested in is we have this big decline, obviously, a base building, and then we get a gap higher on earnings. Obviously, something's changed here, right? The earnings announcement changed the story. Rating turned bullish, outperformance, right? So personality change, solid money flow. Now we're oversold as well. So clearly something's changed in this story. We want to pay attention to it. MLHR is the stock that I'm highlighting in my note today. I'm going to highlight it here on this show. Comm services and supplies. Take a look at this stock. If you're looking for small cap ideas with small cap stocks beginning to outperform, take a look at it. I think you need to pay attention here. I think you need to pay attention to some of the subtle shifts and not so subtle shifts that are playing out in the marketplace, right? Because on those margins, on the edges there, on those shifts, that's where people are either going to be right or get caught off sides, right? So one of the shifts that I'm seeing here is this small cap round. We looked at the levels. We've been looking at them all week. You got a breakout. You have to start thinking about the highs for small caps, which is not something we've been able to say in a while. And if we're going to go for the highs, let's own some bullish stocks that are outperforming. Very bullish stocks that are outperforming. Take a look at Herman Miller here today, MLHR. Hitting our sector tracker now, movement of the major sectors over the last 5 days. There's energy at the top of the list. So clearly we want to be paying attention here. There's a potential shift. Now, I personally think you've seen me warm to different cyclical areas of the market. Back in June, it was materials, right? About 5-6 weeks ago, it was industrials. Me personally, if I look at the relative trends, I have to be honest, the one in financials actually intrigues me more than energy at this point. Financials look like they're a little further along in the base building process, and we have the curve steepening, which is a benefit to the banks. So it's something I'm just watching. It's something I'm paying attention to. But if I was going to shift into the next cyclical area, right now for me, in my view and in my process, it's actually financials that have the lead. Obviously, that could change. If we get a face ripper to the upside in energy, we're going to want to pay attention to that. But if I'm just kind of following the natural progression, I think it makes sense to be doing work on financials. And you can bet that over this weekend, I'm going to be doing a ton of work on both of these groups. Utilities, top of the list, still one that's bothering me a little bit. Right? I'm bullish equities, but the fact that utilities are outperforming bothers me a bit. I'm trying to figure out if it's people coming out of Treasuries and looking for something else to get yield, or if it's people being defensive. I don't know, and we're not going to know. We're just going to have to watch the market and see how it plays out. But as I tried to think about in my head what the rationale could be, it could be that people are looking at yields on the 10-year, yields on the 20-year, yields on the 30-year, and saying, why am I locking up my money for these paltry yields? Look at these utilities over here where I own those. Maybe. Materials and industrials near the top of the list, they're the cyclical sectors I like. Fins, REITs, healthcare, discretionary, middle of the road, staples, and tech round out the groups that are higher. Comms, lower. We all know what's going on with Congress, so pay attention there. Pay attention closely there. For those of you who remember the late 90s when the government went after Microsoft. This reeks of that right now, so just pay attention. Our industry in focus today, insurance services, past 6 months been an underperformer, lagging the S&P 500 by 6.5%. Power bar ratio, very strong here, 25-4, bulls to bears, a part of the financials, by the way. Number 8 of 21 subsectors, down 5 slots over the past week. RGA, Reinsurance Group, PFG, Principal Financial, and American Financial, AFG, all with very bullish Chaikin Power Gauge ratings. If I was going to dig in, I would dig in on the stock level because the fund doesn't look all that compelling to me yet. Obviously, we want to watch for a breakout here. Neutral rating on the fund, power bar ratio, bullish, strong trend above the trend line, but an underperformer with horrible looking money flow. And in the near term, overbought. So the ETF itself, not that compelling, but maybe we want to dig down on some of those names. Remember what I said about the fins. So let's dig down maybe on some of those names, 25 names that are bullish that you could choose from and do some more research on. So take a look at KIE and its holdings. Let's hit what's trending now. Yesterday's movers and shakers, a lot of energy on the leaderboard, right? Oxy is energy. DXC is not energy, but they had their earnings and estimates raised at JP Morgan. That sent that stock higher. HAL and MPC are energy related. DTE actually has some company specific news, potentially selling their natural gas pipelines. That sent that stock higher by 6.4%. Loser side of the board, Domino's Pizza down on earnings. Amgen, disappointing trial results, send that stock lower. Borg Warner, they completed the Delphi Tech deal, but I don't think I don't know why the stock would be down 3.5% on that. Baxter down 3.5% as they withdrew 3 of their 510K applications. And Carnival Cruise Line provided a business update. That stock lower by 2.38%. Let's hit the charts now. And this is what I'm talking about. This is a chink in the armor, a dent in the armor for the growth over value theme. And in particular, the lower high here. Lower high here. You know, I could probably have drawn another line here or here, or however you want to draw it. The lines honestly are subjective. That's why I don't love chart patterns. That's why I like trends. So near term, we want to be paying attention. Right? We've gone from a steady uptrend to consolidation to now we're lower high. Now still above the 200-day moving average. Right? We had a negative divergence at this high on the growth over value theme. Remember, this is when I said don't chase. Remember that? Remember back in late August when I started to say don't chase, it's extended? We don't remain dogmatic in our views here. We pay attention to everything that's going on in the market. We said don't chase, so don't chase. And I pulled back, and then there was opportunity. But now we're looking at it here, and we're saying, okay, what's going on? Right now, it still looks like a consolidation. It's too early to call. Look at the Qs at the bottom. Qs are a SPY, hasn't broken down on a relative basis. But the growth over value trade, this is kind of for the first time in a while, I'm less enthusiastic right now as I watch this play out. I want to give it some time to play out. If it breaks out, we'll get bullish again. That's fine. But we're already ready for that, right? Because we've been starting to skew towards materials and industrials as well, the cyclical trade. So it's funny how that kind of works. The market message gets you in the right direction if you follow the trends. Risk appetite increasing. Take a look at high yields versus treasuries here, breaking the 200-day moving average. Still a lot of wood to chop. There's no two ways about it. But obviously speaks to risk increasing. And it's playing out as yields have backed up. Look at the bottom of the chart there. The 10-year at 76 basis points. I don't know how high we're going to go here. We know the Fed is probably not going to let rates explode to the upside. But, I mean, if they got to 1.5%, that'd be meaningful. If the Fed let them run to, 1.5% on the 10-year, that'd be meaningful. We're seeing the curve steepen, right? Which is why, again, connect the dots, pay attention to what's happening in the bond market, bring that back to the equity market. Go look at my note from Tuesday where I talk about financials beginning to bottom on a relative basis, and then you can understand the thought process and the natural progression. Another sign of risk appetite in the marketplace is discretionary versus staples on an equally weighted basis. Now breaking top side through this near-term resistance level. And that's kind of interesting, especially as it plays out with the RSI shifting to bullish ranges. And we can't hang it on Amazon because we're looking at this equally weighted. So it's not Amazon that's driving this. Remember, for the past couple of weeks, we've been saying as the market was choppy, we were surprised how this was holding up. Clearly, it was giving us a message. I hope you all have a great weekend. Take us for a test drive. I'll be back on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.